Imagine locking up, a massive chunk of your life savings in this totally impenetrable financial fortress.
Right, like a vault.
Exactly, a vault. And it's so secure that market crashes just bounce right off it. Plus, your monthly income is guaranteed for as long as you live. I mean, it sounds like the absolute ultimate retirement dream.
Oh, for sure. It sounds perfect on paper.
But there is a pretty terrifying catch here. That fortress is so incredibly secure that even you can't access your own money when, say, a medical emergency hits.
Yeah, not without paying some seriously punishing fees.
Exactly. And that is the hidden reality of buying the wrong annuity, or just buying one without really understanding the exact mechanics of the trap you might be setting for yourself.
It's a huge issue.
Right, because when you spend decades building toward retirement, your ultimate goal is usually stability. You just want bulletproof income.
You want to know the check is going to clear?
Exactly. But if you blindly chase that stability without depthly analyzing your own life, you might end up totally crippling your financial agility. So our mission for this deep dive is to explore some critical source material. We are looking at an article covering 5 fundamental questions you absolutely must ask yourself before investing in an annuity.
And these are not just generic questions.
No, they aren't. We're going to cut through the sales pitches, bypass the standard financial advice, and really look at the brutal math behind this tool. Okay, let's unpack this because we aren't just talking about buying a stock here.
No, you are legally binding yourself to a highly complex insurance product.
Right.
And to really understand the gravity of that contract, we first have to look at the psychological and mathematical whiplash of the retirement transition itself.
Whiplash is a great word for it.
Because it really is. When you are listening to this, you might be right on the edge of that transition, or maybe you're deeply planning for it.
Yeah.
And you are shifting from a lifetime of wealth accumulation, just, putting money into the pile, to a completely different reality, which is wealth distribution.
Which is terrifying for a lot of people.
Absolutely terrifying. You suddenly have to engineer your own paycheck. And in that high-stakes transition, an annuity should never, ever be an impulse fueled by market panic.
Right, like when the stock market dips and you freak out.
Exactly. The goal here is to help you filter the noise, sit down with the cold, hard facts, and build a protective wall against what could literally be a 6-figure mistake.
Wow, yeah, a 6-figure mistake. And I actually love that phrase you used, financial whiplash, because it perfectly captures what our source material calls the 10-year countdown.
Yes, the countdown.
According to the research, during your primary working years, say, in your 30s and 40s, a lot of us just use target date funds.
We just throw money in.
Right. We throw money in, we totally ignore short-term volatility, and we essentially let the portfolio run on autopilot, like cruise control.
Which is usually fine when you're young.
Right. But the material emphasizes that once you are within a decade of your actual retirement date, that accumulation mindset actually becomes dangerous. You have to radically shift gears. But I guess my question is, if that set it and forget it strategy, that cruise control, built my wealth successfully for 30 years, why is it suddenly a massive liability 10 miles before the exit?
Well, what's fascinating here is the underlying math of something called sequence of returns risk.
Okay, sequence of returns risk. Break that down.
So when you are 40 and the market drops 20%, it's actually a buying opportunity, right? You have decades for the market to recover.
Yeah, you're getting stocks on sale.
Exactly. But if you are 62 and you are retiring next year and the market drops 20% just as you begin withdrawing funds to live on,
Oh, that's bad.
it's disastrous.
Yeah.
You're now cannibalizing your principal at market lows. You might honestly never recover from that.
So the math totally flips on you.
It does. The 10-year countdown is that critical window where you have to actively protect the pile you've built from a devastating sequence of bad market years.
Hence the name.
Right.
Yeah.
And that requires sitting down, ideally with a fiduciary advisor, and defining a highly specific blueprint for what your daily life will actually cost.
Because you can't really pick a defense strategy until you know exactly what you are defending.
Precisely.
Like someone dreaming of a quiet, low-overhead life out in the countryside, they have a completely different risk profile than someone who wants to spend their 70s hopping between international flights and boutique hotels.
The required horsepower is completely different.
Exactly. And this is exactly where the annuity enters the conversation. But our sources make a really deliberate point here. An annuity is not a holistic financial plan. It's just not.
No, not at all.
It is a highly specific single-purpose tool in the larger toolbox.
Yeah, its primary superpower is shifting risk. It takes the risk of market loss and the risk of outliving your money away from you and places it squarely onto an insurance company.
Which is where that ultimate stability comes from.
Exactly. But the source material is very clear that you have to define your blueprint first, because the trade-off for that stability is severe.
I really want to dive into that trade-off because reading through the material, I kept thinking of it like buying a house in a neighborhood with a notoriously strict homeowners association.
Oh, an HOA. That's a great way to look at it.
Right. You get the annuity, and it's like moving into this heavily gated community. Your property values are completely protected. The streets are perfectly clean. You are totally shielded from neighborhood decline.
Sounds pretty nice.
It does. But the second you want to paint your front door red or, park an RV in your own driveway, meaning the second you want to withdraw a lump sum of your own cash outside the agreed upon schedule, the HOA hits you with thousands of dollars in fines.
That is a phenomenal analogy.
Yeah.
It really is. Because in exchange for the insurance company guaranteeing you a baseline income or protecting your principal from a crash, you are surrendering your liquidity.
You're giving up the keys.
You are giving up your agility. And in many cases, you also give up the ability to capture the full upside of a booming market.
Wait, really? How does that work?
Well, let's say stocks surge by 20% in a year. Your specific annuity might actually cap your gains at, say, 6%.
Oh, wow. So you just miss out on all that extra growth.
Yeah, you traded that top-end growth for downside protection. So your specific lifestyle blueprint dictates whether living under those strict HOA rules is actually worth the peace of mind.
Which brings us to the next massive hurdle highlighted in the research. Because once you have that blueprint, you have to stress test it. You have to figure out exactly what kind of peace of mind you are actually choosing to buy.
Yes, and the material suggests a deep dive into your own psychology here. You have to isolate the exact anxieties that keep you up at night.
So we are moving from math to psychology.
Exactly. This is where we transition from mathematics to behavioral economics.
Yeah.
Retirement is always marketed as this golden era of relaxation. Right.
The golf courses and beaches.
Right. But for many people, the sudden loss of a guaranteed salary triggers profound anxiety. You are suddenly hyper-aware of your own mortality, the rising costs of healthcare, and just the terrifying prospect of outliving your nest egg.
It's a lot to handle all at once.
It is. And if we connect this to the bigger picture, annuities aren't just math equations or financial instruments. They are emotional hedges.
Okay, let's actually unpack what that means. Because the research points out that annuities are not a monolith. You don't just go to the store and say, I'd like to buy one annuity, please.
No, definitely not.
There are wildly different variations designed to treat different psychological pain points, right?
Absolutely. Think of them as custom-fitted armor. If your absolute biggest terror is checking your bank account at age 85 and seeing a concept known as longevity risk, well, there are single premium immediate annuities that pool mortality risk.
How does that one work?
You hand over a lump sum, and they guarantee you a paycheck every single month until the day you die. Even if you live to be 110 and you drain the account far past what you originally put in.
Wow. So the psychological relief of knowing you will literally never be destitute is massive.
Exactly. It solves that specific fear.
But what if my fear isn't longevity? Like, what if my fear is dropping dead at 68 and leaving my spouse with nothing? Or watching a sudden illness wipe out our generational wealth?
Then a totally different product applies.
Yeah.
You might look at deferred annuities with specific riders geared toward legacy planning. Those ensure a maximized death benefit goes to your heirs, regardless of market performance.
Oh, okay.
Or there are products with enhanced benefits if you're suddenly confined to a nursing home. The tool has to perfectly match the specific terror.
So what does this all mean for the person trying to build a plan right now? The material explicitly tells you to balance your daily living needs against this long-term anxiety. You have to drill down into your actual safety nets. Like, are you a single income household? Do you have rental income? Which of your existing accounts are going to deplete first due to inflation?
It requires a really thorough audit.
It does. But I have to push back here for a second.
Go for it.
Because it's really easy for us to sit behind microphones and talk about elegantly mapping out the next 30 years. But how can anyone accurately predict which accounts will dwindle when life is just inherently chaotic?
That is a very fair point.
I mean, you can't spreadsheet a global pandemic or a sudden period of hyperinflation or a totally unforeseen chronic illness.
That is a brilliant pushback, and it really gets to the heart of why financial planning is an ongoing process, not a one-time event.
Yeah.
You cannot predict the unpredictable.
Right. You just can't.
But you can assess your vulnerability to it. It's about taking an aggressively honest inventory of the structural integrity of your current finances.
Okay, so looking at what you actually have today.
Right. Let's say you run the numbers and realize your current pension and your Social Security cover your baseline living expenses, your groceries, your utilities, your property taxes.
Your non-negotiables.
Exactly. If those are fully covered, the math suggests you might not need immediate liquidity from your remaining nest egg.
Oh, I see.
In that scenario, purchasing a longer-term annuity that defers income for 10 years in exchange for a much higher potential growth might actually make sense. You aren't predicting the future. You are simply recognizing that your baseline is secure today, which allows you to lock away excess capital for a future payout.
Okay, so you build the perimeter based on the vulnerabilities you can actually see today. That makes total sense. But that brings us to an entirely different kind of vulnerability highlighted in the source material.
Which one is that?
Well, we've been talking about external threats, right? Bear markets, inflation, catastrophic health events. But the research forces us to confront an internal threat, protecting your money from yourself.
Yes. The material refers to this as the ultimate self-assessment.
It's intense.
It requires looking in the mirror and asking a brutally uncomfortable question. Do you actually trust yourself with a massive amount of liquid cash?
It's basically lottery winner syndrome, but for retirees. You hit 65, you roll over a 401k, and suddenly you have like $1 million sitting in a liquid account.
It's a lot of temptation.
It's staggering. For someone who has never managed a portfolio of that size, the temptation is huge. The article essentially asks you to check your ego. If you know, historically, that you are an emotional spender or that you have a hard time saying no when family members ask for loans.
Which happens a lot.
All the time. Or you tend to panic sell stocks the second the news cycle gets scary.
Yeah.
If any of that is true, an annuity actually acts as a behavioral guardrail.
It really takes the keys away from your worst impulses. By converting that lump sum into a guaranteed spread-out income stream, you physically cannot impulse buy a boat.
Or fund a relative's risky restaurant venture.
Exactly. You can't use the money you desperately need for 80-year-old you. You are literally enforcing discipline through a contract.
It's like setting up a strict, unbendable allowance for your future self.
That's exactly what it is.
Which brings us back to the HOA analogy and the absolute most critical part of this source material. Because to enforce that discipline, you are signing a contract with teeth.
Very sharp teeth.
If you break the rules, the penalties are ferocious. The source material lists specific terminology regarding early withdrawals, and we really need to explain the actual mechanics of how you lose money here.
This raises an important question, and this is where we need to dive into the fine print. Because this right here is where the six-figure mistakes happen.
Walk us through it.
The insurance company is guaranteeing your stability, but they aren't doing it out of the goodness of their hearts, right? They are taking your premium and investing it, often in long-term corporate bonds and other instruments, to generate the yield needed to pay you back.
Okay, they have to make the math work on their end.
Right, so if you suddenly demand your money back 3 years into a 10-year contract, you are breaking the math they relied on. And they will punish you for it to recoup their costs.
Right, and the material brings up 3 specific mechanisms of that punishment. We've got surrender charges, bonus recapture, and the MVA, which is the market value adjustment.
Let's take them one by one.
Yeah, let's break these down so our listeners understand exactly what they are looking at on the prospectus, starting with surrender charges.
So surrender charges are essentially a massive exit fee that scales down over time. Typically, an annuity will allow you to withdraw a small amount penalty-free each year.
Usually around 10% of your account value.
Exactly.
Yeah.
But if you want to pull out more than that, you get hit. In year 1 of the contract, that penalty might be as high as 7, 8, or even 10% of the withdrawal amount.
Wait. So if I have a $500,000 annuity and I suddenly need $100,000 for an emergency, I could be paying an $8,000 penalty just to access my own money.
Exactly. You are paying for the privilege of breaking the rule. Now, that charge usually declines every year you hold the contract. It might drop to maybe 6% in year 2, 5% in year 3, until it eventually hits 0 after a set period.
Usually 7 to 10 years?
Yes. But during that surrender period, your liquidity is heavily compromised.
Wow. And what about this bonus recapture the article mentions? Because salespeople love to pitch upfront bonuses. Move your money to us, and we'll give you a 5% premium bonus on day 1. It sounds like free money.
I would say there is no free money in finance.
Ever.
That bonus is just a customer acquisition tool. The company credits your account with that extra 5% to get you to sign. but it's conditional.
So what happens if you break the contract?
If you surrender the annuity early, the recapture provision means they reach right back into your account and claw back that entire bonus, often on top of the standard surrender charges we just discussed.
Ouch. That stings. Which brings us to the MVA, and the market value adjustment. This one seems to confuse a lot of people because it fluctuates. How does an MVA actually work to lose me money?
To understand the MVA, you have to look at how the sausage is made. As we mentioned, when you give the insurance company your money, they go out and buy underlying investments, primarily long-term bonds.
Right, to generate a return.
Let's say they buy bonds paying 3% interest. Now, 2 years later, you want to break your contract and pull your money out. But in the wider economy, interest rates have gone up. New bonds are now paying 5%.
Okay, I think I see where this is going. So the bonds the insurance company bought with my money are now worth less on the open market because nobody wants a 3% bond when they can easily get a 5% bond.
Precisely. If the insurance company has to liquidate those underlying assets to give you your cash back early, they are going to take a loss.
And they pass that loss to you.
The market value adjustment is the exact mechanism they use to pass that loss directly on to you. They adjust your payout downward to compensate for the fact that interest rates rose since you bought the contract.
That is wild.
Now, if interest rates had fallen, the MVA might actually work in your favor, slightly increasing your payout. But the point is, an MVA introduces a layer of market risk into a product that was supposedly designed to eliminate market risk.
That is such a crucial point.
It only applies if you try to get out early, but it's a critical variable you have to be aware of.
Okay, and the final piece of the fine print the source mentions is regarding riders. We talked earlier about adding a rider for a guaranteed minimum withdrawal benefit or maybe a long-term care enhancement.
Right, you are paying an extra fee, usually annually, to attach this rider to your contract.
But the material warns that if you make excess withdrawals, you might unintentionally destroy the benefit you've been paying for.
This is a classic trap.
Right.
Oh, yeah. Let's say you have an income rider that guarantees your future payout base will grow by 6% every year, regardless of what the stock market does. That's a fantastic benefit.
It sounds amazing.
But the fine print often explicitly states that any withdrawal taken before a certain age or any withdrawal exceeding the penalty-free amount will reduce that guaranteed base proportionally, not just dollar for dollar.
Oh, wow. So if I pull out 10% of my money to fix my roof, they don't just reduce my future guaranteed income by 10%.
No, they don't.
They recalculate the whole formula, and it could
Yes.
severely cripple the future payouts I was totally relying on.
Yes. You could completely short-circuit the math of the rider you've been paying fees to maintain for years.
That is insane. So connecting all of this,
Yeah.
if I lock my money in this impenetrable fortress to protect it from my own bad budgeting habits, what happens if I have a legitimate life-altering emergency and I desperately need the key?
It's a real problem.
Like, if my spouse gets a catastrophic diagnosis, am I really just trapped by a 10% surrender charge, a clawed back bonus, a negative MVA, and a totally voided income rider?
That is the terrifying reality. And it is exactly why this source material emphasizes doing this deep self-assessment up front.
Because the penalties stack up so fast.
Exactly. If you lock all your liquidity away, a legitimate medical emergency becomes a compounded financial catastrophe. You are hemorrhaging thousands of dollars in penalties just trying to pay a hospital bill.
You're bleeding money.
The annuity protects you from market volatility, but it completely destroys your agility. If your honest lifestyle blueprint suggests you might need sudden, unencumbered access to large sums of cash, locking everything into a fixed indexed annuity with high surrender charges is a disastrous misalignment of your tools and your goals.
Which perfectly brings us to the bottom line of this entire deep dive. Annuities come with considerable undeniable rewards. The promise of a steady, guaranteed income stream-like, a personal pension in a world full of economic chaos, is incredibly appealing.
It's huge for peace of mind.
It can completely remove the daily anxiety of watching the stock market ticker, but the trade-offs are steep and the mechanisms are rigid.
Very rigid.
We are talking about highly complex contracts, severe mathematical penalties for changing your mind, and the ever-present danger of buying a product that serves an imaginary version of your life rather than your actual reality.
Exactly. Before you even look at a prospectus, sitting down in a quiet room And honestly, answering these core questions about your lifestyle, your longevity expectations, and your own impulse control is the only way to determine if this tool actually belongs in your toolbox.
And speaking of determining what belongs in your toolbox, before we wrap up, we absolutely must share the editor's note explicitly stated in our source material.
Yes, very important.
This deep dive is for informational purposes only and does not constitute financial advice. Investing involves risk, including the possible loss of principal. You should always consider your highly individual circumstances and consult with a qualified financial advisor, ideally a fiduciary, before making any investment decisions.
That's exactly right.
Okay, with that mandatory disclaimer out of the way, here's where it gets really interesting to me. I want to toss it back to you for one final thought to close us out. What is the ultimate takeaway here?
Well, we've spent this deep dive talking about protecting your money from external threats, right? Sequence of returns, risk, market volatility, longevity. And we talked about protecting it from your own present-day spending habits.
Right.
But consider this psychological angle.
Mm-hmm.
How much might your actual identity and your core desires change over a 20 or 30-year retirement?
Oh, wow. That's a deep question.
It is. You might be absolutely convinced that you want a quiet, localized life at 65, only to realize at 75 that you suddenly crave global adventure. Or maybe you realize that you desperately want to fund a grandchild's education.
Things change. People change.
Exactly. So as you look at that blueprint, ask yourself this. Is your financial plan agile enough to support the person you will inevitably evolve into a decade from now? Or does it permanently lock your wealth into serving only the person you are today?